Jonathan, at Lex, we have long been admirers of Next and its CEO Simon Wolfson, but the shares are taking a battering this morning. Give us the news.
So the news today is that sales guidance has been downgraded to a lower range, and that implies a drop in pre-tax profits of about 3 or 4% from the previous sort of consensus of analysts' forecasts. That's a contrast to the outlook given at the start of the year, which was relatively benign, and the approximate cause for that downgrade is not only a general slowing down in the economy, but also a specific shift in consumer spending patterns. So people, according to Next, are spending, or there are signs that they are spending less money on clothes and more money on other stuff like travel and eating out.
This sounds quite scary, not only because of the actual downgrade to the targets, but because the outlook changed so quickly. Is this as bad as it sounds?
Well, it could be, but I think that you have to bear in mind that Simon Wolfson has a very long history of playing it very safe with forecasts and guidance. Much better to under-promise and then over-deliver. Now, he talks about this year being the most challenging year since 2008, so it's worth kind of winding the tape back.
Yeah. How bad was 2008 for this
2008,
company?
they predicted a 6% or 7% decline in like-for-like sales at the shops. In the event, the like-for-like sales decline came in at 6.5%, so within that range. But actually, the shares a year later were trading 7% higher against a 40% drop in the FTSE All Share. And there's another interesting.
So we might hope for another 2008.
Yeah. So he uses, yeah, indeed, he uses this metaphor of sort of running up a down escalator. He's used that metaphor before in 2011. Guess what? A year after he made those comments in 2011, profits up 20%, share price up 40% against an index that was flat. So that it's not necessarily a sort of portent of doom for shareholders.
So the shares are down something like 12% today.
Yeah.
Does that fit with is that a match with the actual cut in targets they've given? Is it in proportion, in other words?
No, it's not. There's a big mismatch. So the company has lost about £1.3 billion of market value today, which is a lot for a FTSE 100 company. The analysts' forecasts revised to take account of today's statements are for pre-tax profit of about 820 million. So the company has lost about 50% more in market value than its entire forecast profits.
So what that has to mean?
That has to suggest something more fundamental.
Yeah, that the trend in growth over the long run is going to come down. That's what a 12% decline in the share price means, is that it's not this year, it's next year, it's the next year, it's the next year.
Yeah, and the most obvious explanation for that is if you look at their Next directory business, which has been the engine of growth recently. This is a catalogue and it's online sales. Now, Next was very quick into this market, way ahead of many of its rivals. And what's happened is I think that you're seeing the business maturing. Rivals like Debenhams, Marks and Spencer's have poured money into revamping their websites and getting online apps and so on. And I think that just reflects perhaps a maturation of that business, people expecting lower growth rates going forward. Also, Next is finding it harder to attract account holders, people who sign up for store cards.
Yes.
And that's significant because historically those customers have been more profitable, not massively more, but slightly more profitable than people who just go online and pay with cash and debit cards.
Jonathan, thanks very much.